Okay, so can we then start? Hello to everybody. I'm very proud to chair this NAEC meeting. It's super interesting, and if we come out with a conclusive answer today, I think we are all ready for the Nobel Prize, but of course most of all Steve. So I'm very happy to announce Steve Keen. I think he's really, very, very much in the spirit of what we are trying to do here with these meetings about new approaches to economic challenges. For sure, we have these challenges, and for sure, Steve is somebody who really offers us some, say, alternative ideas, alternative possibilities, alternative answers, and also alternative policy for that. And so this is really great to have him. So. For those who don't know him that familiar, just a bit of a background. In autumn 2014, Steve became professor and head of School of Economics, History and Politics at Kingston University, London. He was formerly associate professor of economics at University Western Sydney. So living in Sydney and London for me does not look that bad. Okay, living in Paris, of course, I wouldn't say anything against that. So he completed his PhD in economics at the University of New South Wales. He's also well known for criticizing, say, the typical standards neoclassical economics as being to a large degree inconsistent, empirically unsupported, and even probably in parts of them unscientific. So he draw a lot about Hyman Minsky's financial stability hypothesis. This is the main basis. He will elaborate a bit on that in a minute. I wondered when I read it these days about Minsky, I thought, where did I read it? And then I came back because I also did my PhD on the methodology of economics and also the history of economics a bit, looking at rationality concepts. And so far about scientific or unscientific, I stumbled about this economics of disaster, which I read in the 80s, and so that's so now I thought, how ever got I this name, but now I knew. So, and this is of course a major contribution to economics, and this is concentrating on mathematical modeling and the simulation of financial instability via these certain tipping points. And I think also in looking to the macroeconomic debate we have, I think there is a lot of weight about monetary policy in the array of zero lower bound or a very low rate of not natural rate of return. And I think there is this idea, if you start a certain monetary policy, and you can clearly see this also in the upswing to the first to the last crisis. You can clearly see that monetary policy is triggering via the financial sector asset prices. Asset prices will move, and I think there is an idea of doing macroeconomic by bubbles in the sense that you use a bit of a constructed financial bubble for making people richer, let them do investments on the financial sector. Then, of course, at the end, this bubble has to be deflated. But in a perfect world, this then would probably already trigger then investment in the real sector. So macroeconomic by bubbles, we are kickstarting the real economy. But of course, you have to be sure whether your macro pru cuts it off at the right point in time and not the wrong people just getting richer and the others just getting poorer. So we will hear about that 10 years now from the start of the global financial crisis. So Steve is one of handful of economics to predict another crash, and he warns that this another crash is almost inevitable. He will now tell us why. Steve, you have the floor.
Thank you very much. Wonderful introduction, and thank you very much for the invitation as well. I wasn't aware of NAEC before being invited, and I'm delighted that it exists. And as I said earlier to the ambassadors, I think there's more chance for a pragmatic reform of economics coming from institutions like the OECD than there is from universities. So I want to see this initiative continue for a long time. Of course, the question is that the OECD didn't do quite so well back at the time of the crisis. I'm sure you're all aware of that, but I'll do the embarrassing of starting from the economic outlook of June 2007. And of course, those of you who read that document would know that it started by talking about rebalancing being the future for 2008. And the key comments are here to say that the current economic situation, bear in mind this is written in May and published in June of 2007, better than we've experienced in years. Central forecast is quite benign. Sustained growth with strong job creation and falling unemployment. Now, the reason I have more faith in organisations like the OECD and the Bank of England and so on, despite this record, is that you have to wear the consequences of getting it so badly wrong in a way that academic economists do not. They can retreat back into their supply and demand curves and ignore reality and come out 30 years later and pretend they know what they're talking about. You've got to deal with politicians and real-world situations now. And you need a pragmatic approach to economics, which I think you've got a better chance of achieving and bringing about than the universities, which will hide from reality in the meantime. Of course, you weren't the only ones to get it wrong. Probably my favourite is actually from the Federal Open Monetary Committee, chief economist of the Federal Reserve, speaking in December of 2007, using the same words. Our forecast can be read as painting a pretty benign picture. Despite the turmoil, we avoid recession. Of course, that's now the date we now record the recession as having started. So it's how seriously badly we were misled by conventional economic thinking. So why didn't they see it coming? Well, David Miles, who was a member of the Monetary Policy Committee in the UK, basically said, well, it can't be predicted. And he criticised somebody I have a lot of time for, Andy Haldane, in saying economics needs to be reformed. He says, no, it doesn't. Any criticism of economics saying that it failed to predict the crisis and therefore it can't be trusted is saying as much as saying we can't trust mathematicians because they can't predict who's going to win next week's lottery. And that fundamentally is saying that crises are random, no more predictable than a lottery. That's pretty much the argument. Now, that depends on the theory you use. For example, comets were unpredictable according to Ptolemaic theory because they were atmospheric phenomena according to Ptolemaic theory. Of course, we know they're not. The neoclassical models, crises and instability, are anomalies. They're not the norm. They're the anomalies for the theory. And they're caused by exogenous shocks when they happen. But in the work that I do, which comes both, I use Minsky as a major foundation for what I do, but fundamentally it's coming out of a complex systems vision of the economy. And this thing, crises are not the exception, they're the rule. And they're not exogenous, they're endogenous. They come from the system itself. So I want to show you how to do that without talking in great detail about Minsky. I'm simply going to start from a set of macroeconomic definitions. And Olivia Blanchard and I have had some little fights over the internet, some good correspondence as well. But one thing we completely agree upon is we do need to have some foundation to start economic modelling from which you can't dissent. And that was a large part of the motivation for DSGE models. Let's start from something we all agree upon, which is micro, and build up. I don't agree with the micro, but I want to start somewhere we equally can agree, and that's macroeconomic definitions. So I start from the definition of the employment rate, which is the number of people with a job divided by population. The wages share of GDP, which is the wage bill divided by GDP. And the ratio of private debt to GDP, which are strict definitions, which you can't disagree with. And I convert them into a dynamic model, but I show the mathematics of this is in the back of the slides, by simply differentiating those statements with respect to time. And when I do that, I get three dynamic ways of expressing the same definitions. And this is what they end up being. The employment rate will rise if economic growth exceeds the sum of population and labour productivity growth. That is directly derived from that definition. The wages share of output will rise if wage rises, whatever determines them, exceeds growth in labour productivity. And the debt ratio will rise, and this is fairly obvious, so it's the last one I actually worked out myself because the debt equation in my model was so complicated when I looked at it. The debt ratio will rise if debt grows faster than GDP. Now, those are all, that's not a model, those are three verbally true definitions. To convert it into a model, you have to make some assumptions. Assumptions have to be made in any model, so I'm not criticising making assumptions per se. So I simply assume that production is a linear function of how much capital is installed. Investment is a linear function of the rate of profit. Wage change is a linear function of the employment rate. All, of course, simplifications of reality, drastic simplifications. And investment in excessive profits is financed by borrowing from banks. So I don't have any Ponzi investment going on here. All the investment that occurs is genuinely producing new factories, new output capability. So I'm not looking at the Ponzi side of Minsky here. Now, when I put that together, I get a model which is highly stylized. It certainly can't be used as a quantitative predictor of the economy, but it's the qualitative behaviour I want to capture. And what it predicts is you will have a crisis if the ratio of private debt continues to rise compared to GDP. And if you have a low level of desire to invest, you will not have a crisis. But then you'll have a very stagnant capitalism. And what you will do in that system, you will taper to an equilibrium ratio of debt to GDP. Income distribution will also stabilise. Employment stabilises. That's, if you like, the ideal economy, but it comes out of capitalists who aren't particularly aggressive in wishing to invest. So if I simulate that model over time, pardon me, you can clearly see a process of convergence to equilibrium taking place then. I'll just, since I know now that the software will work, I'll just actually quickly simulate that here. So this is my Minsky software, named in honour of Hyman Minsky, of course. It lets me simulate any dynamic process whatsoever, but I mainly need it for the economy. And you can see a process of convergence there. The employment rate is stabilising, the debt ratio is stabilising, the wages share is stabilising, income shares are stabilising. That's the equilibrium we'd like to have. But as a non-linear model, this can bifurcate. So if I go from that to a higher desire to invest, which is what you would want, you have a breakdown where the debt ratio gets past 150% of GDP and continues rising, and there's rising inequality as well. But the remarkable thing about this model when I first developed it back in 1992 was that it predicted a great moderation before the great moderation actually occurred. And I remember showing this to my econometrics lecturer at the time, lovely man called Eric Soey. And Eric's reaction I'll never forget. He stored at the three-dimensional graph I did of the process. He said, "Steve, if you've uncovered anything that actually exists in capitalism, we're in deep, deep trouble." Now, I really thought it was almost like I didn't take my model seriously as a model of the real world. It was too stylised. But it actually happened. We know we had the Great Moderation and the crisis afterwards. And I'll show you that exactly the same thing happens out of this incredibly simple model if I simply make capitalists more willing to invest. And what appears to happen is the cycles moderate more rapidly. And if you extrapolate that, you expect to head towards stability. What can happen in a non-linear model that can't happen in a linear one, which tends to dominate neoclassical thinking, is the cycles get larger. And rather than the great moderation being a sign of continued stability, which is the way neoclassical economists interpret it, it's a signal of an approaching crisis. And that's what I'm showing here as well. Now, that's a very stylised model, but what you can see is you've got a rising ratio of private debt to GDP. You have a rising share of income going to bankers, and even though in this model it's the firms, the capitalists that are doing the borrowing, the people who pay for it are workers with a falling share of income, which again is what we've seen. The inequality Piketty has identified, we all now concede is the actual nature of the system, is what occurred, and you have this apparent moderation before the crisis coming out of an incredibly simple model. Now, of course, without that model, the way conventional economists interpreted the Great Moderation was that it was a good thing. This is Bernanke from 2004, but you can find statements right up till 2007 saying it's a welcome change in the economy. Now, when I wrote this model, I've got a slightly rhetorical side to my personality, so I thought I'd finish with a nice rhetorical flourish at the end of my paper. I didn't expect it to become reality. I said the vision of a capitalist economy with finance should make us go beyond the habit of mind that Keynes described so well, the excessive reliance upon a period of stability in the past as a guide to the future. And that's what actually happened. A period of relative tranquility was not something we'd expect to maintain forever, but it was a lull before the storm, which of course arrived in 2007. Now, the main insight coming out of Minsky's work and out of this very, very simple model is the main destabilising factor in capitalism is private debt. And that is ignored by mainstream economics, and it's still ignored a decade after the crisis. If you read Joe Stiglitz, who's one of the most progressive of mainstream economists, he's writing papers 10 years after the crisis, which is still not focusing upon the aggregate level of private debt. You might talk about the distribution occasionally, but not the aggregate level. And if you think again about the education most of you would have had in economics, because mainstream economics hermetically seals finance from economics, in finance what it tells you is the best situation for firms is to have 100% leverage if they can deduct interest payments from tax, as they can do. Now, what that's meant is, if you look at the historical record, what you see is a growth in private debt that has given us the highest level of private debt in human history. And that's happened right under our noses, even though we've collected the data. So the data, the main data I've got there is the data for America going back to 1834, and I had to hobble together some data series to do that. But the UK is the most interesting series. This is the Bank of England's own data. And you see that from 1880 to 1980, private debt never exceeded 75% of GDP. But then from the deregulations to enable largely the mortgage market to be taken over by banks rather than building societies, they rose from 55% of GDP to 190%. Japan gave us the prelude, hitting 220% of GDP. But we're now in the aftermath of this crisis, using America and Japan as a reference point. We are carrying a debt level that in the UK's case is 3 times the average debt level it had from 1880 to 1980. So that's what I see as the real reason why we're still stuck in a crisis 10 years after the beginning. We're living in the biggest private debt bubble in human history, and in some ways government policy is still promoting that. I'm thinking we have to get the banks lending again without reducing the level of aggregate debt we've already accumulated. So what actually causes a boom is rising credit, which leads to rising leverage. And when you look back at the historical record now, you can find that the really serious crises in capitalism have been periods where private debt is falling. So the contribution of credit is negative rather than positive. Just looking again at the American data, we're going back to 1834. And the blue line down the bottom there is showing the annual change in debt. I define credit as the change in debt. So debt is denominated in dollars, and credit is denominated in dollars per year. And when you do that with the American data, you find that the crisis of 1837, known as the Panic of 1837, was one period where credit was negative, running at about minus 10% of GDP for that period. Then we have the Great Depression. Now, of course, we focus upon this enormous explosion in the debt ratio, but in fact, across that period of time, debt was falling. The GDP was falling faster, so the ratio blew out. Another time where credit hits about minus 10% of GDP. And the third time that happened, of course, is the recent financial crisis. So those are the real dangers: accumulation of private debt followed by deleveraging leading to negative credit, meaning the credit system is removing demand from the economy rather than adding to it. Now, crises occur with a combination of 2 factors: a high level of debt and then the rate of debt growth turning negative. And the reason it matters is that when you have a high level of private debt, you can have a reduction in aggregate demand even when credit is still positive. And I want to give an example of this as well, but my basic insight from doing the empirical work here is that aggregate demand in the economy is the turnover of existing money plus credit. And the plus credit bit is the part that's omitted from mainstream economics, and also in a lot of ways from a lot of post-Keynesian work too, unfortunately. But if you have a low level of, imagine an economy with $1 trillion per year as the turnover of existing money, and that's growing at 10% per annum. And you have a debt level of 50% of GDP, which is $500 billion worth of debt, and that's growing at 20% per annum. And these are all quite realistic rule of thumb figures. That means total demand in that economy is $1.1 trillion. $1 trillion from turnover of existing money, $100 billion, which is 20% of $500 billion, is the growth in debt that year, which finances that much demand for both goods and services and assets. So next year, if GDP grows by 10% or turnover existing money grows by 10%, you have 1.1 trillion. If the rate of growth of debt slows to 10%, that's 10% of 600 billion, which is 60 billion. So your total demand is $1.16 trillion, which is $60 billion more than the year before. So you've still got growth in aggregate demand going on with a low level of private debt. Now, if you consider a high debt ratio, same GDP, same rate of growth, but private debt's 200% of GDP, and that's the level we're talking about for many countries around the world today, then 20% of 200 billion is $400 billion. So total demand in that economy is much higher. Looks like the economy is booming. We might call it a Celtic tiger. That gives you total demand of $1.4 trillion in the first year. Now, next year, you have the same rate of growth in the turnover of existing money, 1.1 trillion turning up there, but growth of debt slows down to growing at the same rate as GDP, so the ratio remains constant. That means you have 10% of $2.4 trillion, which is 240 billion. You add that to your GDP, your total demand is 1.34 trillion. That is $60 billion less than the year before. So even stabilising the debt ratio leads to a fall in aggregate demand. And that's what traps us. We're not expecting that. So both the level of private debt and the rate of change matter. And with that figure, I can use a rough rule of thumb to say that we don't actually measure the turnover of existing money. We do measure GDP, which is mostly paid out of existing money. So roughly speaking, you can use income plus GDP plus change in debt as a rough guide with a 10 to 30% double counting error to what your situation is. And that is what I looked at to say a crisis was coming. So looking at the United States and looking now at both debt as a debt ratio and change in debt over that extended period from 1945, right at the beginning of the post-war period, was the last time credit was negative. And all the way through 1945, all the way through to 2007, credit remained positive. And then the plunge that occurred at that stage is what caused the crisis. Notice the debt ratio is still rising. Okay? The peak occurs after the crisis. And then we've had deleveraging since then. Now what we're seeing is a return to leveraging, nowhere near as large as before the crisis. But that's what gave us an apparent recovery. But it's a recovery with a level of debt which is still, on historical standards, the highest it's been since 2000. So we can't get out of the crisis until we reduce that level of private debt. So there's negative credit. First time, the third time it's happened on a grand scale in America's history. So neoclassical economics ignores this, but this is what I find remarkable. We're ignoring what's in plain sight. Because according to mainstream economics, if you read Ben Bernanke's essays on the Great Depression, he rejects Irving Fisher's debt deflation hypothesis as an explanation for the Great Depression on the basis that debt is a pure redistribution from debtors to creditors, and therefore unless there's enormous differences in consumption propensities, there should be no impact from the change in debt. He ignored this data effectively. Now, the correlation coefficient there between change in debt and the unemployment rate is minus 0.91. That's a fair distance from zero. So this is what we're ignoring. But it's data that's in plain sight. And it was in plain sight to some extent for the 1930s as well. Equally, when you look at asset markets, and I've done the empirical work on Granger causality here as well with some colleagues in England, which I have to publish shortly. I've been dragging the chain of getting this paper written for a couple of years. But change in mortgage credit, which is acceleration of mortgage debt, Granger causes house price change. So the real cause of house price bubbles is not tightness of supply, it's the supply of money that causes those bubbles. And again, when you look at the crises, across the countries that had a crisis in 2000, either Japan's case, of course, back in 1990, or America, UK and Spain during the last crisis, they've all had that experience of negative credit. So this is the explanation both for the boom before and the crisis afterwards and the stagnation which is continuing. It comes down to the private financial sector. Now, there are countries that didn't have a crisis back in 2008, and China, of course, had a very brief but very powerful crisis. Canada recorded a recession, but South Korea and Australia were two of the countries not to record a crisis back then, and they're very proud of themselves. The reason was they avoided that negative crisis credit experience. So the dotted line you can see there is where credit is above zero. And for all those countries, at the time of the crisis, they remained in the positive area. They didn't have the negative credit experience. So they managed to avoid the crisis by continuing to borrow private money. Now, of course, what that's meant is they've accumulated a much larger debt ratio. So looking at those same countries and using the USA for reference, China, Canada, Korea and Australia are all running now to over 200% of GDP as their debt level. Korea's 190, but it's still pretty close. So all those countries avoided the crisis by increasing their leverage, where America experienced the crisis and its leverage level fell, but it's still at a historically high level, which is why I divide the world into two groups, what I call the walking dead of debt for those who had a crisis back in 2007, and the zombies to be, who avoided a crisis by continuing to borrow money, but their crisis has to come when the rate of growth of debt slows down. And as you can see, for many of those countries, they're starting to go through that slowdown process at the moment. So I'm expecting those countries to have a crisis in the next 1 to 3 years. So the precursors for a crisis empirically, and Richard Vague is another person I suggest you invite to speak to you here. Richard's got the weirdest last name in history. Yes. He's the most precise man I've ever met. And he established two of America's major credit card companies. He won't tell me how much he's worth. He's worth a lot. But in running a credit, the consumer credit side of his business, he got worried about the level of mortgage debt that he saw occurring in the build-up to the crisis. And he then became a critic of the extent to which we create debt in Western society. He's now running what he called the Private Debt Project. And he commissioned a study looking at all the economic crises of the last 1.5 centuries. And in those crises, he found that there were two empirical triggers that applied across all those countries. Private debt exceeded 1.5 times GDP, and over a 5-year period before the crisis, that debt ratio rose by 17% or more. Now, America, the UK, Spain, etc., well and truly qualified for that back in 2007. These are the countries that identify as now fulfilling those criteria, ranked, of course, by the scale of their GDP. So if you look at China, which is the most egregious example, its GDP is now over $11 trillion per annum. When the crisis, 5 years ago, its debt ratio was 148% of GDP. Now it's 210%. An enormous increase in its private debt level. Absolutely gigantic increase, the biggest in history. Canada, a 35% increase. South Korea, a bit smaller, but still the debt levels are much, much higher than Richard's trigger level. Australia qualifies. Sweden, not quite the same increase in debt level, but an enormous level of debt to begin with, and Belgium. So those are the countries I think are most likely to have a crisis in the next 1 to 3 years. And other possible crisis countries include this list, including France and Singapore, the most likely ones. So crises are not going to occur in the countries that had a crisis back in 2007 because they're still caught in the aftermath. They're suffering from what I call not secular stagnation, but credit stagnation. But the countries that are likely to join them in the next 1 to 3 years include those ones, particularly the ones in red that I've shown in that chart. So how do we handle a crisis? Well, what we've done is austerity. And I can understand the appeal of austerity. This is the current Prime Minister of the UK saying Britain must live within its means, which is very much the rhetoric that it hits us in the gut because we all try to do that to some extent. Okay, some of us leverage up and speculate. We believe we should be living within our means. That's an individual idea. So if you can imagine this as an economic sector, imagine a sector earning $200 per year and $200 billion per year and spending $200 billion, making no savings, then it tries the next year to spend 10 less, earn the same amount, put aside 10. That's the sort of perspective we have. So you're starting with zero savings. You spend, I'm using pounds here because I gave this presentation. I should have changed it to euro, my apologies there. Spend £10 less, put £10 away for a rainy day. Well, let's all try doing that. Well, let's now just arbitrarily divide the economy into three sectors and see how it looks from the other two sectors' point of view. Let's imagine they're all starting at the same point. They're all spending 200, okay? Now, one of them is spending 10 less. That sector A saves 10, but it's now spending 10 less collectively on the other two sectors. We're now up in a deficit. So the savings by one sector becomes a fall in income for the other sectors. And that's the problem. We think we can save at the national level, but we can't. All we're doing is redistributing where the money is. And if one sector accumulates a surplus, the others necessarily, whatever they might be, accumulate a deficit. They're now dis-saving. That wasn't their intention. Now, what happens if they decide to do the same thing? Okay? They've got to spend less than they earn as well, or try to. But that means in the aggregate, they don't reduce spending, they reduce income. They reduce spending and they reduce income. And there's no net saving going on. And this is the expenditure income identity, which we haven't got through to our politicians properly, or indeed to ourselves, largely because economic theory works without money, which is not true. Capitalism is a monetary system. When you acknowledge that, what you spend becomes somebody else's income. If you try to save, you are reducing somebody else's income. So let's look at this if now all sectors try to do this. All sectors, we start with £600 billion per annum spending, and individual and aggregate savings is zero. And now all three sectors attempt to save 10. First of all, sector one gets into the games. It sets off the process, causing a deficit for the other two sectors, identical to its increase, its surplus. So GDP has fallen by 10 here, with aggregate savings still being zero. What if sectors B and C also decide to save by spending less? Well, what happens is spending falls by 30. The attempt to save money reduces GDP by exactly the intended level of savings. I want to ban the word savings from macroeconomics. It's what individuals do. It's what's aggregate you cannot do at the aggregate level. Now, one of my favourite quotes from Marx is this one from Volume 1 of Capital. Accumulate, that is Moses and the prophets. And that's true. We all have that desire to accumulate. But is it possible? Well, whole economies can't do it unless there's some sector that spends more than it earns. Now, what can it be? I'm going to pull this sector triple question mark here. I've got a sector which is earning 20 from each of the other sectors and spending 30. Now, if it does that, it dis-saves by 30, but the other sectors can each accumulate 10, which is what they're trying to do. So what can that sector be? Well, it could be the banking sector, lending more than it gets back in repayments. And if it does that, okay, we all get extra money in our deposit accounts, but independently we also get extra debt to the banks. So there's no net increase in financial assets. We can get a bubble out of it, we've all done that. Okay? But we can't get net increase in financial assets. But if the government spends more than it gets back in taxation, that increases our deposit accounts by 30, but it doesn't give us a matching debt. When the government buys something off you as a contractor or gives you something as a welfare payment, it does not come with a matching debt. Okay? It may have to finance that through taxation, but it's not something that falls on you individually. So you get an asset without a liability. It's a liability elsewhere in the system. It's not what comes up in your account. You can therefore save. Now, the question is, how does the government get that? I know the rules prevent this being done directly, okay? I know I need to put in more tables to make it fit the current legal situation. But if central banks do open market operations, or QE of any form, they're effectively doing what I'm showing in a summarised form here. So I have the Treasury financing that 30 by issuing 33 worth of bonds, the central bank buying those bonds off the Treasury, and then the Treasury getting 33, which you can spend on the private sector, and 3 of that turns up as interest payments to the central bank, which increases the central bank's equity. I'm using negative signs here, by the way, as an accounting convention. That's an increase in equity for the central bank. And then the government, the Treasury, then spends that money on the public, so it turns up in their deposit accounts. Now, if the government runs a surplus, goes in the opposite direction, this is a different form of table where I'm showing these things as positive. It's various conventions for different mathematical purposes. If the government taxes 20 and spends 10, it accumulates a surplus of 30, which means a deficit of 30 for the other sectors. So the government attempting to run a surplus for itself puts the rest of the system in even more of a deficit than it is initially. So often the private sector's response to that is to borrow money from the private banks. It doesn't necessarily, it's not a causal link necessarily, but you have 2 options. Pardon me, if the government is running a surplus and taking money out of the economy, then the monetary value of turnover will decline unless you borrow money from the banks and spend that, and then you get a private debt bubble, which can give you really lovely times. We might call one of them the roaring 20s and the other the naughty noughties, but the end response to that is a financial crisis. So rather than saving for a rainy day, it's preceded major crises. Governments running sustained surpluses have only occurred twice in America's history. Once in the 1920s, and the other briefly under Clinton before the Iraq War began in the 1990s. So running a government surplus is a prelude to a financial crisis. It's not a way of avoiding it. And this is just to show you the American data. Despite all the rhetoric about trying to run surpluses, making that objective, the 2 times it's managed to do that are the 1920s, where things went slightly wrong after that, with first of all the Great Depression and then of course the Second World War, and then under Clinton. And that surplus was a prelude to the crisis when it was forced into deficit again. Government should normally run deficits, at least equivalent to the nominal growth of GDP. So, how do we get in this situation? Well, partly we got here because we have models of capitalism that presume it's a barter system, leaving out money entirely, leaving out the banking sector, leaving out debt. And Minsky attacked this so well by saying we have a theory of economics which presumes crises can't happen. Now, in fact, because they do happen, to actually understand them, we have to have a model of capitalism where crises are possible. We have to have an economic theory which Great Depressions are one of the possible states in which the system can find itself. And if we have models of the economy where that can't happen, we don't have models of capitalism. And yet that's what we were relying upon, and we are still relying upon before and after the crisis. So that's the theory. We really need to get theories where money plays an essential role, where debt is fundamental, where non-equilibrium dynamics apply, all of which apply in the real world. Now, the policy implications that leads me to at the fairly simple level that I've got these theories developed to at the moment. First of all, because excessive private debt is a problem, reducing it is the solution. We have to find a way to reduce private debt. Now, we found a way back in 1939. It was called the Second World War. We do not want the Third World War to reduce debt again, but we could effectively do it using government's money creation capacity. If we rely upon the private sector to do it alone, then we get what I call Fisher's paradox, after one of the most important components of Irving Fisher's debt deflation theory of Great Depressions. And in talking about that experience, he said the very effort of individuals to lessen their burden of debts increases it, because the mass effect of a stampede to liquidate, as he put it, swells the dollar. The amount people pay down debt is exceeded by the fall in GDP that occurs at the same time. The more debtors pay, the more they owe. And that's clearly what we saw happening during the Great Depression. The debt ratio rose even as the level of debt was falling, because the impact of that debt being paid off, taking money out of circulation, destroying money, led to GDP falling even more than debt levels fell. But government money creation could do it. We did it during the Second World War by spending, in the UK's case, the deficit in 1940 was 40% of GDP. Now, nobody objected to that. Nobody said we can't afford to drop that extra bomb on Germany, pardon me, but they did. There was an existential threat, so we ignored all those controls. And as a side effect of that, we drastically reduced the level of private debt, which gave us the boom in the post-war period. We could do the same thing now without violence by not QE, but QE for the people, a direct injection into household bank accounts, where those who have debt have their debt reduced, but those who don't have debt get a cash injection. But I'd add the requirement that that has to be used to buy corporate shares, and those corporate shares must be used to reduce corporate debt. And that would reverse the damage we've done to income distribution through QE as it's been practiced, which has only rewarded those who currently own shares, drastically increased their wealth, increased the inequality over and above what the crisis itself caused beforehand. And that would reverse the income inequality we've already caused, first of all, by the private debt bubble, secondly, by QE, which has worked, but has been misguided. We've had a massive increase in share prices, a massive increase in wealth for those who are already wealthy, and a trivial benefit through the poor, partly through pension funds, mainly through some increase in turnover of existing money. If we don't do it, I think we face continued stagnation, not because of secular stagnation, which is Larry Summers' attempt to understand it, on the belief the financial crisis is over, but credit stagnation, as we've seen in the case of Japan. And then, in that situation, what happens? We get the type of political earthquakes we're seeing around the world, where the centre is rejected and the extreme left or the extreme right is embraced. And as we all know, particularly when it's the extreme right, that's a very ugly experience. We don't want to repeat it. Thank you.
So, thank you, Steve. I guess this is really a lot of food for thought and for further discussion. But before we open up the floor, our friend Paulo Laria from Portuguese delegation.
Not anymore.
Not anymore, but long time. So you will go ahead with comment.
Okay, thank you very much, Professor Keane, for this very stimulating talk. And thank you also, William, for inviting me to provide these quick remarks to the presentation. But before that, let me add a quick personal note to say that I worked in the financial industry, in liability management, in debt, including derivatives.
Wow.
So I have my responsibility also in the crisis. But the most fundamental thing is that I fully understand the framework and the concerns that you just presented here today. And I share your view that the financial sector should play a bigger role in economic thinking, in economic modeling, in economic forecasting. I think the monetary and financial variables are very, very important, more important than we used to use in our models. But I guess you are more specific than that, and you argue that debt, or more precisely, private debt, should be at the core of economic analysis. So my comments, very briefly, would be around the fundamental question of your book, can we avoid another financial crisis? The second, which debt is bad debt? Household debt, corporate debt, or public debt? Are those debts all equal or not? And finally, some thoughts about policy options going forward. So, the first point, can we avoid another financial crisis? Well, taking a long-term perspective and based on Reinhardt and Rogoff's work, it seems there is no hope. As they argue, short memories make it all too easy for crises to occur. And I think this is a very interesting point, and it supports the NAEC spirit, in fact. We should continue this dialogue around crisis prevention and crisis management, especially when the economic perspectives improve, because memories are very short-lived. So my understanding from reading your book is that this time could be different only if we change the system in a fundamental way. But at the same time, my view is that we have improved significantly the financial system in the last few years. We have now macro and micro prudential tools, stress tests, more capital, leverage ratios, tighter controls, supervision, closer cooperation, and so on and so forth. Perhaps additional instruments could be introduced to increase resilience even further. But I think this is a very complex and interesting topic. And you quoted Larry Summers before. And in a 2016 paper, Larry Summers argues that big banks have not gotten safer in the aftermath of the crisis. And why is that? One of the possible reasons is that excessive regulation prevents banks from hedging some of the risks. So, in that sense, they are more vulnerable to adverse shocks. So, Professor Keane, maybe it's time to rethink the system as a whole, and regulation by itself, it's not enough. Or regulation could have adverse impacts. The second topic, you put a lot of emphasis in private debt. Some authors put the weight on public debt. But what I think could be interesting to the debate would be to go a little bit deeper on the different types of debts and ask ourselves if we should have a special focus on one type of debt or another type of debt to improve the stability of the system. And in one of the most important books that came out of the 2008 financial crisis, The House of Debt, which, by the way, you quote in your book, the authors argue that at the heart of the GFC was not the breakdown of the financial intermediation. The problem was the deterioration of household balance sheets, not corporate debt. But in your book, you quote some examples, or you give some examples of excesses also in corporate debt market. But I would argue that for some corporations, like SMEs, corporate debt is essential for expanding their businesses. So I think a little bit more of discussion among these type of issues, maturity, interest risk exposure, quality of debts, could be helpful in framing the debate, not by putting a limit by itself in the level of debt. And I think there is a recent and very interesting paper by the OECD staff that do that. The paper says or argues that, or raises the question, too much or the wrong kind of finance. And this is, I think it's a critical issue. And finally, key policy options going forward. As you mentioned, 10 years after the crisis, indebtedness continues at very high levels. Several authors raised the question, deleveraging, what deleveraging? And as you showed, debt is now higher in many cases than it was prior to the crisis. But one thing is to solve the legacy of the GFC, and another one is to build a better and safer system going forward, to avoid creating these imbalances in the first place. And as I said before, important measures to mitigate risks have been introduced. And you spoke about complex systems, and I would call your attention to the fact that the European regulatory framework now places greater emphasis on identifying and addressing system-wide risks. They didn't do that before the crisis. And this is important to assess interconnections among banks. And there are other economists like Martin Wolf recently that advocate equity requirements much higher than the current regulatory regime. And in a recent CEPR conference, John Vickers from Oxford asked, has banking reform gone far enough? And his answer was no. So I think we have a lot of food for thought in this debate, a lot of ideas. Thank you, Professor Keane, for pushing the reform agenda in the financial sector And I hope your contributions are important for the debate, and we can continue this conversation going forward. Thank you very much.
Yeah.
So, thank you, Paulo. Then first I would give the floor back to Steve, and then open up the floor, please.
Okay. Well, I'll try to be brief because there's a lot there. I think a lot of what we've done is remedy one half of the crisis and ignoring the other half exists. And that is, we thought it was all about prudential regulation and stopping banks getting into situations of negative equity, because if a bank has negative equity, it is bankrupt. This is why the crisis occurs so rapidly, because the assets of banks obviously include the price of the financial assets they own, whereas the liabilities tend to be deposits, which don't change anywhere near as fast as asset prices can. So if we go back to the Lerman experience, I think it was Lerman, John Paulson talks about receiving a call from whoever was the head of Lerman, of course I've forgotten who that is, he's long gone, saying that we really need some finance now, we're going to be bankrupt. And Paulson said, how long do you have before you go bankrupt? The answer was about 3 hours. Okay. Now, of course, when you've got a collapse in asset prices and your liabilities effectively constant, then your equity falls. And as soon as a bank hits negative equity, it's gone. So a huge part of what's being focused on is saying, let's get it fixed up so they've got such a level of capital stock that they can't have that fall in asset prices leading to them have negative equity. And that's covered. We've got the capital rules. That's all fine. Okay? But we've ignored the accumulated level of debt. So that is why I focus on the aggregate so much, and why I don't worry so much about the quality of debt, as you were talking about later, because everything we've done so far said, well, it's all about the quality of debt, whether we give debt to the right people, and you can ignore the aggregate level. My point is you cannot ignore the aggregate level. This is the fallacy of believing that lending is by financial intermediaries, where it's going from one person to another. And if I model that as I do in my Minsky software, I can bring that up later if we have enough time in the conversation, I can show a dramatic increase in the level of private debt and a dramatic fall in the level of private debt using the model of money creation that mainstream economics has, where banks are intermediaries, and no impact upon GDP worth speaking about. Because as Bernanke says, if lending is a pure redistribution, it only really matters that there's huge differences in spending propensities between the sectors. Otherwise, it's irrelevant. He's right. But the real world we live in is one where banks create money by lending, as was now being admitted by many central banks. And in that world, the increase in lending causes a boom, a decline causes a slump. So the aggregate thing matters. So I'm probably overemphasising the aggregate, but only because everybody else ignores it. So the quality stuff still matters, but we have to focus upon the aggregate as well. And then that comes down to how do we reduce the aggregate level of debt. Now, as you said, aggregate debt, when you add government debt to private debt, it's still rising. Okay? And fundamentally, again, Richard Vague's work is very important here. He said looking back at about 150 episodes of financial crises, none of them have involved the economy growing out of the debt, which is what we're all hoping we can do. The only instances where countries have got out of a debt trap is where there's been an export boom, say for Saudi Arabia, where oil prices quadrupling totally eliminated domestic debt. But apart from effects like that, we've only got out of it by writing the debt off. So we have to get to the stage we say we can abolish the debt. Now, of course, that inverts the political power of debtors and creditors. At the moment, by far, the powerful group in both the minds of politicians and in terms of the way we all think about the world is creditors must be repaid. And that's, I think, projecting our own personal experience of debt from the banking sector itself. But if debt's created by double entry bookkeeping, banks can create too much of it and have an incredible incentive to do so. So we have to see debt as like scorekeeping and be willing to change the scores, write that debt off. And if we don't do it, we're going to be stuck in this trap. I'll leave it at that and go to open questions.
So, please, the floor is open. Yes, please.
Thank you very much. This is very good food for thought, and the message is very clear. I would just like to mention a few points. Number one, your simple model assumes away, I think, the dynamics that comes through the risk premium channel. And risk premium channel is very harsh, and it leads to immediate deleveraging, which immediately is reflected to aggregate demand collapse. So that would even accelerate, actually.
Yes, indeed.
What you have in your model, but it's good to have a model even without risk premium dynamics. So I was happy to see this simple model.
Yeah.
I understand how it works. It works through income distribution and the impact on aggregate demand. And it's good to have such an alternative. So that's number one. Number two, just a word of caution. I'm a former central banker, so I have to say this. Be careful about what you recommend. So QE for the people is very dangerous in the following sense. It can immediately be translated to inflation unless you have some brakes in the system. And it's very difficult to introduce brakes once you open that door through the political economy mechanism. And we have lived through this in the 1970s. So you also have to have some safeguards on unsustainable growth of public debt.
Yeah.
So that's my word of caution. Thank you.
Yeah. On that point, that's something which has been said back to me quite regularly. On that point about QE for the people potentially causing a large amount of inflation, that's been made to me on several occasions, and it's true. I mean, partly also we actually are trying to cause inflation right now and failing. Okay, so a certain amount of that would be useful. But what we can also do is use the QE to increase the ownership of equity across society. We could potentially say that we're setting up QE for the people because it's a gift we're giving to the people in that sense. So it comes with a condition: the money you get must be spent buying shares. Now, if you do that, what you do is change the distribution of share ownership. You don't actually, and you can use that to reduce corporate debt, you don't actually inject any money into the actual spending system. So it's possible to fine-tune this, and I would like to actually test run this. There's no way I want to try a policy as radical as that without saying what's the impact of a small trial. And of course, we went into QE with absolutely no trial, just hoping it would cause a wealth effect and hoping it would cause spending. It's clearly done some of that, but the scale of which we've done it is absolutely enormous, given that compared to the benefit, which has been fairly small but still there. So QE for the people we could test in a smaller way and set it up with that limitation that you must, if you don't have debt and you therefore get a cash injection, you must use that to buy shares, and the corporations that sell those shares to you must use that to pay their debt down. We could trial that out and see how it works. So those issues are definitely there, but we have the capacity to investigate and see how they actually work out in practice.
Yes, please. Agree.
Thank you very much. The presentation, just to follow the discussion, what we had also early morning, now we have it in details. I do agree with you that over this argument that austerity is not a solution in that way. It has also from economic and maybe also from political point of view is not a way. Just looking your alternative, but you have an alternative policy or some step to it, the main question is, do you have also some practical example? That means not just a suggestion, the point what you mentioned. And may I just go a little bit back what happened in Hungary? Hungary was the first country 2008 which has been bailed out. Yeah? The first policy was between 2008 and 2010 is the austerity. And after that, 2010, we introduced, I would say, just few measures, like you mentioned also here. Because one of the main reasons was the private debt, and the private debt for mortgages denominated in foreign currency, which is the crazy thing. But we introduced many measures how to pay back, and at fixed exchange rate, we obliged to pay back all these. Hungary has been the first country to put levy on the banks and also other sectors. We introduced the flexible labor market, and you mentioned also to inject money in the households. This means we introduced also a flat personal income tax. That means 16% for everybody. But at that time, it wasn't so easy to make it. So we have been the black sheep in an orthodox measure. I remember very well sitting maybe in this room at the ERCD in 2011. In that row, and all the countries was that it's impossible and orthodox, it is not a solution, and so on, and all these things. I could say, no, the public debt level is 75%. Deficit is always around -2%, and the GDP grows by 4%. So I would suggest in that case, looking at in details your suggestions, and maybe to take some examples of countries. How is it? I can just say one thing. It is not too easy politically to put in practice.
Absolutely, yeah.
But I survived.
Yeah. The person I'm going to give an example of didn't survive, and that's Kevin Rudd, because. Sorry, thank you.
No,
thank you
do
very much. Keep forgetting.
it's better I give a hand.
Okay. The invisible hand?
Yes, this invisible. Adam Smith.
Kevin Rudd, who was Australia's Prime Minister at the time, I'm sure some of you experienced him over here at various points. He was actually interviewed on the Australia's major current affairs program the day after I was interviewed for half the show, warning about the crisis. And the week later, he came out with a budget measure which included a roughly $1,000 cash injection for everybody who paid their tax that year. I managed not to get it because I hadn't paid my tax at the time. But there was effectively $1,000 for everybody in the country who'd paid their tax, turned up as a cheque. And they called it a tax rebate at the time. Now that's part of why the Australian economy didn't go into a recession. And the Treasury Secretary at the time, his little saying, which was quite emphatic, was go hard, go early, and go households. And by doing all those, the stimulus from that, one of many stimulus they put in, but that meant the economy's spending continued. The trouble is it restored the bubble. Okay, and they also doubled and trebled the amount of money they gave to households to buy houses. They call it the first home owners boost. I call it the first home vendors boost, and it kept the house price bubble going. So there were negative side effects to that, but certainly that's an example where that cash injection had an immediate impact, and the economy didn't go into a recession. But politically, you're extremely right, because one of the limitations we face is that not only do politicians think that living within your means is a good idea, the public thinks the same thing. And if you try to do something which involves the government spending more, where's the money going to come from? Burden on future generations, all these ideas turn up. They're unfortunately about as sensible as Ptolemaic astronomy was. Okay? But because they're believed, we act upon them, and therefore we stymie the policy responses we can actually make. And largely you've got to not just educate the politicians, you've got to educate the public as well. And the political barriers that puts up are enormous. And there really is no way about it apart from slowly developing an intellectual discipline which understands these things. Because the reason we talk about sunrise now is because it's a legacy from when we used to think the sun did rise. But anybody who thinks the sun actually rises these days is a lunatic who believes that the earth is the centre of the universe and it's flat. So our mental understanding takes time, and it really relies upon the experts being correct about it. At the moment, unfortunately, the experts are wrong. I describe modern economics as Ptolemaic economics. And so long as that's the case, the public is never going to understand that, yes, the government should spend more than it gets back in taxation.
Yeah, depends. Okay, so now we have Korea and then Greece, and I would take them now as a bundle. Korea first.
Thank you for your presentation, in particular, including Korea as a geography. It will be significant warning to Korea. I'd like to mention policy implications. I think I really agree reducing private debt is a solution. In this regard, strengthening the macroprudential measure is very important. But regarding your solution, it can be, I think, roughly speaking, it seems to transfer or transform the private debt to public debt. So I think high public debt is also a problem. So in particular, in case of Korea, which is so open to a global economy and does not have global currency, the rise of public debt is also a problem. So I'd like to ask your opinion about public debt rising.
Okay.
No, I would like to take.
Oh,
can
sorry,
I take
pardon
two?
me, yes, sure. Yeah, you
Please.
Okay.
Quick.
So, thank you, Chair. You've troubled me. See, I'm an unreformed Keynesian. 1936, not later.
Yeah.
Then. Now, your model is a little bit too simple in a qualitative sense, not that it has few variables or equations. How far can one get with definitions? You can simulate, but can you inject theory at some point in the argument between the original definitions you gave us and talking, as Paolo raised the matter of Rogoff and thing about the last time and this time and so on. It's a long distance. I want to leave the political economy out of it. It's a huge thing.
Yeah.
And it really goes very, very far. So, allow me to be apolitical. It's very difficult
Yep.
assumption. Okay. Now, you have two possibilities. There's the theorizing of the neoclassical, which is absurd,
Yeah.
but extremely powerful in that you can inject so-called theory at any point in the argument. You can go on and on and on and on. I mean, it's a true epicycle kind of situation. And the other thing, which is your one, which is where from? In the only person I think who used the equations to anything like a remotely resembling extent is Mickey Caldwell with his stylized facts. But he went to the simulation, he started the wrong way, and they're all wrong anyway. But, stable wage share, stable this, stable that. He went to the steady state and then inferred what he thought was theory. But even so, there was a theory, I think profoundly wrong, but that's another matter. The distribution theory, the Cambridge, so-called Cambridge theory of distribution, which didn't get anybody anywhere. Now, you start with your equations, your definitions. Is there any theory in anything you've said to us today? See, you bring in money. You don't talk about income, you talk about GDP, product. It's fine by me, because I think income is product. It's a cost, I mean, it's gains.
Yeah.
But then you bring money as an independent, a thing like income, but it's unlike income. It's not produced, but it can be spent. So you're almost touching dangerous things, loanable funds theory.
Oh no.
Almost. I'll take this back.
Yeah.
It's another time. It's another time. Yeah. So you have income as defined by GDP plus or minus credit, which is non-produced income, in the sense that it can be spent. But credit presumably is generated for people to spend. Whereas income need not be spent, having been produced.
Yeah.
So you can have unsold goods, which are the beginnings of some theory.
Yeah.
But you can't have unspent loans, which would be another, because why did you
Borrow in the
contract
first
in the
place?
first place? Now, I think somewhere between that and your helicopter money, you didn't call it that, but it's the same thing. There's got to be some theory. I mean, money is an asset and like all assets, it has a yield, nearly zero, but so it has a carrying cost, nearly zero, but that, and it has a liquidity premium. Now, just to wrap it up. Now, are we in a liquidity trap, yay or nay, in your theoretical predisposition? Not in your theory, but in your hiding behind your head. That's my question.
Yeah.
Thank you.
So now, Steve, it's yours.
Okay. To go to the... I actually might take the questions in reverse order because this is a good theoretical framework, because a large part of what I do is I'm talking most of the time to people who are neoclassical economists.
Okay.
Okay.
So you just
And if I come in and say, well, here's, deriving my work from Marx, Graziani, Schumpeter, Fischer and Minsky, the following is my, well, bang, I've lost them already. Okay. Now, if I start with a set of definitions, okay, it's very, very hard to lose on that front. So it's a large part of why I've done what I've done today, because there's a huge amount of theory behind what I'm doing. So that theory is non-mainstream. So like if Graziani, for example, I mean, one of the great thinkers on monetary theory, most neoclassical economists would, Graziani who, but the insights that led to me building my Minsky software came from Graziani. My work on Minsky came having originally read Keynes and Fischer and Schumpeter and Marx and so on. So I want to ultimately get us back to having that as the theory we learn, and actually I'd go right back to the physiocrats, okay, and learn that. But you're starting initially with people who know none of that and who would reject anything predicated on that set of assumptions. So the easy thing for me says, I can derive it from a set of definitions, and what I get out of those definitions, the phenomena you didn't see coming that actually happened. And partially to twist back on the answer as well, when you think about what we observe as economists, and I see great economists like Schumpeter, like Keynes, like Fischer, like Minsky, what they're observing and what they put into a theory can only be a superficial level of understanding of the overall system we're in. Capitalism is so complicated. Okay. A lot of what you can get out of that comes out of very simple insights. And that's the beauty of a complex systems understanding. And if we go back to look at where complex systems work came from, largely in meteorology with Lorenz, his struggle was to convince his fellow meteorologists that they should not model the weather as a linear system because the fundamental forces were non-linear. But to get that through, the equations that are involved in fluid dynamics are 11-dimensional partial differential equations. Having a conversation from that, forget it. Okay? What he did was he worked right from those massively complicated equations down to a system with 3 differential equations, 3 system states, and 3 parameters. And then that generated the complex dynamics he wasn't even aware was going to happen. So what I'm trying to do is get us back to the same foundation and say, even at the simplest possible level, just working with stuff we cannot disagree with, then we see the phenomena that look like the sort of things that Schumpeter and Minsky and Fischer and Keynes and even Marx spoke about. So, and then we say, well, let's now look at their insights from that foundation. So there's a huge amount of theory. I'm disguising a lot of it deliberately now, but I want to be able to move from that point forward. And that's a lot of work. And I'm an unreserved Keynesian as well. Policy implications, the importance about, if I'm talking about an increase in public debt to reduce private debt, then you get all the issues that come out of that. A large part of those issues does not matter to a country running a trade surplus. Because with a trade surplus, when you're selling those bonds, they're not going to be sold to anybody outside your own country. You don't need to sell Korean bonds to Americans to finance the Korean government deficit, because you can sell those in Korea and Japan and Germany, China, all the countries running a trade surplus. They're well insulated. Countries that have a difficulty doing that are countries like Australia and Canada that have a trade deficit, and a large one. So I see Korea as being safer on that front. But equally, it's possible to regard the creation of money by the government as not a debt issue, but an equity issue. If you say we're sharing the equity of the country with the public, here's a cash injection which we're going to effectively finance by seniorage, which we're then giving to you to democratise ownership, not to take assets away from the wealthy, but to give assets to the poor, then you can sell that as actually a very populist thing to do. And if you end up in a crisis, then is the government saying we're going to share in the wealth of the country by sharing share ownership, by giving you money that you can do that with, then I think that's its potential to get through the public's resistance by saying it's not debt, it's equity. And a large part of what we've allowed to happen in capitalism too is too much debt. I'd like to refine the financial system to enable venture capitalist firms to be banks, so that they create equity positions in firms rather than taking debt positions. So a large part of it is reducing our reliance upon debt. Because we often, I know there's a group called Modern Monetary Theory, which you would have surely heard of, which talk about all money is created by debt. What they're saying, all liability is created by assets. Those assets don't have to be debt, they could be equity. So it's that sort of reshift that's necessary. As to whether we're in a liquidity trap, we were in one when the financial crisis hit because so many banks entered negative equity. Okay? That's the genuine liquidity trap. But of course, if you are an unreconstructed Keynes, you know Keynes rejected that as an argument, except in times of collapses of the Egyptian empire. So in general, we can have a massive desire for liquidity caused by a crisis that means people want to get rid of assets that are not fungible and get hold of money immediately. That's a real liquidity crisis. We've got through that now. We're now, I'd say, not in a liquidity trap, but in an excessive debt trap. And that means insufficient credit, so therefore insufficient demand growth over time. So not a liquidity trap, but a credit trap.
Okay, so I look around there. Yes, please, one more.
First of all, thank you very much for the very interesting presentation. I had a couple of questions. You showed a couple of graphs showing that the levels of debt were increasing sort of since the post-World War II period.
Mm-hmm.
What would you say would be the sustainable aggregate level of debt?
Yeah.
Can you put a number on it?
Yep.
And secondly, in terms of getting out of the crisis, what do you think is the potential to reduce the debt burden through inflation? And we've seen caution on the part of the Fed and the ECB following the taper tantrum incident in 2013, and now they're probably not going to increase rates until December and then proceed quite slowly after that. So, what's the potential for us to have a gradual exit from this situation of extreme amounts of QE, just sort of playing the devil's advocate? And finally, in terms of the trigger for the next crisis, you said there might be a crisis within the next 1 to 3 years. What could you give us some ideas of what might trigger that, and maybe comment on auto loans or other debts and liabilities such as pensions, which are maybe not accounted for in these numbers?
So then we collect another one, and then I think we wrap it up, please.
Hi, my name is Dan, and I'm an infrastructure economist, and I'd just like to check whether me and possibly some other people in macroeconomics might have problems because the macroeconomists got something wrong. In particular, I'm not sure if you're aware, but most governments take very seriously their levels of debt. And you will hear a common repeated mantra that there is not enough space, so we must look for private financing to build new infrastructure, for example. But at a fundamental level, for people who know the difference between funding and financing, and knowing the fundamental tenet that if you get more benefits from taking on public debt, then you get disbenefits from the added taxation, then you should take on public debt. Is the current macroeconomics surrounding public debt and limits on public debt misguided? And we should actually use public money to get more infrastructure, because we know for a fact that the ex-post cost of private financing is higher than the public financing for infrastructure, for example.
Yeah. Okay. In terms of a sustainable level of debt, I'm never going to talk in terms of something being optimal, because I think that's a neoclassical fantasy about working at optimal levels in an evolving system. But anything below 75% of GDP seems sustainable. Once you start getting above 75% of GDP, that seems to be when you start getting significant impacts from credit, because when it's that larger relative to GDP, its change is also large relative to GDP, and therefore the ups and downs of credit have a large impact. And that's why I think, to some extent, the belief that the public debt is irrelevant is actually wrong. Okay, I think it's the importance of public debt is drastically overstated by mainstream economists. But I'm particularly fascinated by that. I'm trying to find the data here for the UK. That's the blue line you can see there. What you can see is that for 100 years, that level never exceeded 75% of GDP. And they weren't a bad 100 years for the UK. And for half of that, it was the world's leading empire. So there's something about the mechanisms back then that stopped private debt accumulating too much. And it may well be that with the public sector backstopping the private sector as much as it's done since the Second World War, that's partially where the increase in private debt has come from. Okay, so we have to see what's the impact of public debt on actually allowing too high a level of private debt to accumulate. And if you notice, again, looking at the American data here, even though I said there was that period of massively negative credit, I focused on those three massively negative experiences. You can still see that during the 1800s, there were regular periods of credit being negative. Okay. Now, it's only since 1945 that there's been a sustained period of no negative credit whatsoever. So in some ways, the fact that the government can backstop so much because it's 3 to 5 times the size it was compared to GDP before the Second World War, that's partially enabled the private sector to build up as much debt as it's done. So we have to find a way of not of letting it accumulate that much, but writing it off. So I see the relationship between private and public debt being extremely important. And just thinking we can have as much public debt as we like, if it encourages this behaviour in private debt, it's going to cause a problem. So there are complex issues there. I don't think we've got a correct right answer on any side of economics. In terms of a gradual exit from QE, I don't think there's going to be one. I think what's going to happen is because QE's underwritten such an increase in share prices, and because central banks have become so committed to believing that there's a wealth effect and therefore high share prices are a good idea, then they start doing QE that's going to reverse the monetary flow. Rather than the government, central bank being on the buy side of assets and causing rising asset prices, they're going to tap on the sell side. To be on the sell side, they've got to be taking money out of the financial sector, which they will do partially by selling assets, which will cause asset prices to fall. Now, when that happens, I expect central banks to panic and go right back into QE again. Okay? Which is a real negative. So that slow exit I don't think is going to happen. I think it'll be a share market crash. Oh dear, we can't have that happen, back on the buy side again. And then we're going to continue driving apart asset prices and consumer prices, when part of Minsky's theoretical insight was you can't have a massive gap between asset prices and consumer prices. Ultimately, we have to finance them, if we're going to finance them successfully, out of the turnover of existing goods and services. If we're financing it by inflating instead, we're going to have a crisis at some stage. So that QE has set us up for an enormous problem we have to solve. Reducing asset prices is an essential part of getting out of the crisis. But of course, we've got wedded to the idea that increasing asset prices is a great idea. So that's, I see a real problem there. In terms of triggers, it's endogenous, because demand comes from turnover of existing money plus credit. When the plus credit becomes zero, that triggers the crisis. Okay? But having said that, there's so much nefarious lending going on, as we all know. It used to be in mortgages, now it's auto loans, student loans and so on. I can see student loans in particular being a trigger there, because we're giving an entire generation the inability to buy houses and the inability to service its own debt. Their lack of spending is going to mean a slump, and then lots of student defaults and so on. I can see the government coming out and bailing those students out again, because it's politically suicide not to do that at some point. So I see the triggers coming particularly from the student loan point of view. And on infrastructure can be financed by, not amazed, I couldn't get the battery charge here, my battery's about to run out, pardon me, I'll just save it in a moment. We can finance infrastructure so long as there are physical resources available to build them. And that's both labour and capital we can create by building those resources in the first instance. So by going for believing we need private money to do it, we don't. We simply need to have unemployed resources. Now in America's case, we fool ourselves into believing America's at full employment again because the unemployment rate is low. But if you look at the figures, and this is on the Federal Reserve database, OECD data I believe, the employment rate for 25 to 54-year-olds peaked in 2000 at about 82% of the population. It was 80% of the population, these are rough figures, in 2007. It fell to 75%. It's now 77.5% or thereabouts. There's still about 3 million Americans who had jobs in 2007 that don't have them now. I wonder who they voted for. Now, if we had them actually building infrastructure, as I believe a certain political candidate said he was going to do, and hasn't yet done, then we would both build the infrastructure and finance it with publicly created money, and maybe have them not voting for him anymore.
Okay, so